Investors are bracing for another big rate hike from the U.S. Fed tomorrow. When looking to keep your portfolio stable amid unpredictable markets, are traditional investing strategies the way to go, or should investors get a little more creative with where they put their money in uncertain times? For more on how to manage your portfolio amid volatility, let's bring in Rob Tetrault, Senior Portfolio Manager at Canaccord Genuity. Thanks so much for joining us, Rob.
Thanks for having me, Jacqueline.
So what sort of changes have you been making to clients' portfolios amid the volatility that we've seen this year?
So the changes that we made to portfolios actually happened years ago, and many, many, many years ago, when we started adding alternatives to portfolios, probably 10, 12 years ago, just seeing that there could be a prolonged low rate of return on the fixed income side, and equities were extremely volatile. We just basically took the pension style approach. We looked at the largest endowment funds on the planet, the largest pension funds. What are they doing? And I studied this when I did my MBA, my finance MBA years ago. And then I just kind of applied that to our practice. And we started doing that years and years ago. So the changes for us happened before the volatility. So the exposure to the clients to the volatility was way less.
Okay, so I mean, I guess if a client was coming to you now or maybe a prospective client and wanted some help making some changes, what are the sort of most important pillars, I suppose, of what your strategy is? Okay,
so first off, what should be the asset allocation is the first thing a portfolio manager should look at. So traditional portfolio theory says that you should have, your stocks in your age. Well, your bonds in your age, excuse me. So, that's, to me, that doesn't make any sense whatsoever. So let's look at the purpose, the reason as to why you own bonds. If you own bonds to reduce volatility, if you own bonds to have income, or if you want to reduce correlation, let's look at those three reasons and figure out which ones actually need you to have bonds as a fixed income product. There might be other solutions that are better. And then I would likely lead you down the path of you probably should own alternatives, especially if you have a corporation or if you have a personal non-registered account. These things are remarkably tax favorable. And for your corporation, you don't have to worry about the grind against your small business tax exemption. So it's incredibly favorable. So I would look at adding 10, 20, maybe even 30% of that to your portfolio.
Okay, let's get to the alternative stuff in one sec. But just in terms of, you mentioned bonds, what's your outlook on that side of things? Because it's been a rough year for bond investors as well.
Yeah, I mean, I was saying this last year and 2 years ago. Why would you want to own something that's going to pay you 1% for the year for the next 10 years? Plus, you're going to get eroded. You're going to pay tax on that. You're left with half of it. You're going to get eroded as interest rates go up. So my outlook on bonds is that I'd rather not be in them until we see some stability in the interest rates. So we're not there yet. We're going to see increase in interest rates. Who knows how much? Extremely volatile if you own a 30-year or 10-year bond. A lot of these bond funds have significantly long duration, and we're seeing clients get eroded on that basis. So why would you want to own that? Instead, you're likely way better off to either sit your fixed income on the sidelines, either in a short-term duration investment or in a private alt or something different than traditional long-term bonds.
Okay, Rob, so let's get into the alternative investment side of things. You're not saying go all in on alternative assets, but having a portion of your portfolio invested in this way. What are some of the types of alternative investments that you're considering or that you would consider?
Well, okay, so to me, there's different types of investments. I would consider a whole whack of them, but let's focus on three of them. Private real estate, remarkably inflation sensitive. So when inflation goes up, you get that bump. So multifamily real estate is a core holding of ours. Private infrastructure. So people are paying you to use your assets. Infrastructure. Think of large projects where there's effectively a short-term rent being paid to use that asset, whether it's a toll bridge, whether it's an airport, a pipeline, a real infrastructure, solar project, something like that. And maybe farmland, another real asset. It's a phenomenal inflation tool again, because less and less farmland, more and more people, that's a supply and demand problem that we're addressing by owning a little bit of farmland in our portfolio, and we think that'll be good. So those are three simple ones that I just threw at you.
So how do you own farmland in your portfolio? Like, you're not saying actually go buy farmland?
No, we do it. We do it for the clients, Jacqueline. So
okay.
As a PM at CG, so my firm is dedicated to allowing portfolio managers to operate in the best interest of the clients. So there are other firms that don't allow you to do so. But for me, at my firm, I deal with third-party pension-style managers, and they issue either limited partnerships or private pools or funds, and we participate in them for our clients.
What would be some ways that people would be able to gain exposure to these alternative ideas with, on their own, if they're a retail investor that's looking for some of this type of exposure?
Well, I don't think there's an ETF for farmland. I don't think so. You could try to get some commodity exposure, but the private REITs would be tough, and the private infrastructure, I don't know that there are funds or ETFs that exist for the retail investor at home, and it's not my area of expertise, but I do know how I do it, which is, again, through those private pools, those funds, or those third-party limited partnerships.
Okay.
Sorry, that's not great help for you.
No, it's fine. It's fine. Outside of those, I wonder if there are other sort of alternative things that you'd be thinking of that might be, more accessible to your average investor.
Well, here's the problem with these alts is that every Tom, Dick, and Harry firm out there is putting product out to try to entice the retail investor to just load up money into that. And they're not all good. In fact, most of them are not good. We've heard of liquid alts, and there are ETFs for that. And we've heard of long, short ETFs or hedge funds. Those are not the same alts that I would consider true, pure alternatives, right? You want to have a reverse correlation or an inverse correlation with stocks or bonds, and you want to make sure it's not a black box that the portfolio manager can do whatever with. It's an asset allocation play, and not just let's just put some money into something that's not stocks.